Please welcome CEO and Managing Partner, Riller Capital, Cyril Shaw, and the Wall Street Talks panel.
I'm supposed to have a panel, but maybe they didn't show up. So thrilled to be here at the Hunter Conference, thrilled to be back here. Thank you to the Hunter family for having me, and now I have a panel, thankfully. I'm thrilled to be here with our esteemed colleagues. We have Kevin Jacobs, CFO and President of Global Development at Hilton, Mit Shah, who's the founder and CEO of Noble Investment Group, Scott Trebilco, Senior Managing Director at Blackstone, and lastly, Shai Zellering, who's a Managing Partner of Real Estate at Brookfield. Okay, so we'll get right into it, because I think everyone knows these guys and we don't have to do long introductions. But quick fire question. I asked this last time and we'll get into that. Total value of all the assets you will buy and total value of all the assets you will sell between now and the next Hunter Conference. We'll start on the end with you, Shai.
Well, thank you for having me. Nice to be here again. Every year I think that the timing of this conference is always interesting. Last year, the prediction, I think, for me was a little bit more optimistic, more aggressive than it ended up being. We ended up selling about $1 billion worth of assets. The Conrad in Seoul, with a lot of help from our friends at Hilton, a bunch of other assets, mostly outside of the US. We are net buyers this year. Both globally and in the US. As contrarian investors, I think this is a great time to be active. On the sell side, we don't feel the pressure, and we'll talk more about it, I'm sure, during the panel.
Great.
24, I believe I said we would sell $2 billion of assets. We actually sold right around $2 billion of assets last year. I see us selling about the same magnitude this year. On the investment side, last year, I believe I was also optimistic. I think I said $5 billion. We did about 10% of that, so my forecasting is not particularly strong. I think this year it'll be somewhere in between.
I think this time last year, we were optimistic that the transaction market was going to significantly pick up. Like I think we all have been as we entered this year. And, we did look at a lot. We looked at $6 billion of assets. We invested only $800 million in assets last year, where I thought that we would do at least twice that amount. But I'd also say that we didn't think that we would have as much of an escalation in mid-scale extended stay from an acquisition and a development. And so that actually outpaced what we thought the opportunity was going to be there. We thought that we would sell more assets last year, about $500 million. We were a little less than that. As we looked at this year, it is not a defined term, but a really wonky environment that if you would have asked, I think, probably most of us a month ago, our thesis was that we would probably sell a little over $1 billion of assets this year and buy $2 billion of assets this year. I'm not ready to give up on that. I think the transaction activity is very interesting right now. I'm not sure that we sell the amount of assets that we thought that we would, to Shai's point, not pressure to do that, but we felt like that the opportunity was going to be there in the market. So we'll see.
I'll just go.
It's not really our thing.
Yeah. So Scott, going back to kind of that on the acquisition side, it seems we're emerging from kind of a deep slumber in hotel transactions. I think 22, 23, 24 were all very muted from a hotel transaction standpoint. Can you tell us a little bit about maybe why you think that's happened other than interest rates, and maybe more so why you think that'll change in 25?
Well, I think if you wind back the clock a year, I think sitting here, we hadn't made a hotel acquisition in the US in 2023. And so I guess you could say we emerged from the slumber because we did 3 acquisitions last year, all one-off, very bespoke acquisitions. And I think when you think about the environment that we went through last year, at the start of last year, there was an expectation for 7 cuts. And it didn't eventuate. The SOFR was meant to go down to 3, and we're still in the low 4s, and the expectation has been moving around. So that weighed, I think, on people as we went through the year. We have been also looking at relative value across different asset classes. So we've been very active outside of hospitality in the US, data centers, the housing segment, retail as well. And we're also looking at opportunities internationally. And we've just seen more opportunity across different markets internationally over the past year. We deployed about $1 billion into the Japanese market, about $1 billion into the European markets. We've just viewed at different stages of the recovery. And so we've been sort of focusing not just domestically, but on our global strategy in the business. I think when you look at where we've actually transitioned to today, if you sort of just step back and said, well, credit spreads and all-in cost of debt's probably down 300 basis points from 12, 18 months ago, because credit spreads have come in dramatically. Supply is way down, and there's no signs that supply is going to pick up anytime soon. Demand has been relatively resilient, and lenders are actually out in pretty meaningful scale. It's pretty broad-based right now between traditional banks, the private lending market, the CMBS markets. Everything's functioning pretty effectively. You would think that would translate into a lot of economic activity and transaction activity, but I think what we've found ourselves in is the cost of capital in totality between equity and debt is still elevated. Most of the people deploying capital are more biased towards opportunistic core plus type returns. There's not a lot of core capital. There's not a lot of international capital coming into the US hotel market today. The combination of that coupled with a moderating growth environment and revenue that hasn't outpaced inflation, that's really translated into a more difficult environment to make opportunistic returns. And I think that's why you're seeing this bid-ask spread sort of persist.
So then, so Mitt, if STR said in 2024 that 2024 ended at 1.8%, and they're saying the same 1.8% RevPAR growth for the U.S. in 25, if it's not keeping up with inflation, where is this optimism kind of coming from in that the transaction markets are going to kind of rebound?
Yeah, I thought that with all due respect to our friends at Smith Travel and Lark and CBRE, that there was, I think, a healthy amount of conservatism thinking about this year as we enter this year. Because if we just go backtrack, we finished the year really strong in 24. And I think that some of the vol that we were concerned about felt like it was kind of build on optimism with regards to, just business investment, that business, traveler coming back on Monday, Tuesday night, and a lot of demand patterns that we started to really see. In January was fantastic. February was even better. And March started off, really strong. And what's interesting about that is that they said 1.8, but then they updated their forecast, 6 weeks ago, and they said, hey, we think it's going to be 2.2. Well, based on where March is trending, the signal is they're going to bring it back to 1.8. And so, I think the near term remains very cloudy because we don't know the impact of, all of this policy is actually going to have long term. And I know that we can go down a rabbit hole with that. Right?
We'll get there.
And so,
We'll
but it feels very self-inflicted because the reality is that businesses want to invest. They want to continue to grow, and travel is a natural investment in doing that. Whereas it used to be an expense line item, for those of us who've been in this business for a long time, it really is a growth, type of endeavor. So my view is that I think it's murky over the near term, but I still believe that the long-term secular demand trends of people that are spending in experiences over things, and people that recognize travel as a necessity in terms of business growth are there. And then when you combine that with the supply situation that exists, I feel a lot more optimistic about the future than potentially like sitting here today and wondering where March is going to end up and what does that mean for the next quarter and perhaps on just kind of given that cloudy piece. And last comment on that. But I also understand that everyone's got to come up with their forecast. So if you just look at all the REIT stocks that posted earnings, everybody was conservative because nobody wants to overpromise and underdeliver. But I just think that we're in a time frame where it's going to be a little bit murky.
We'd love your thoughts, kind of what you're
Yeah, I think it's. I mean, Mitt hit it on and touched on it at the end. I think it's time frame, right? I mean, so I think if you're thinking about these investments over a longer period of time, I think the long-term setup for travel, both globally and in the U.S., is quite strong. I think if you think there's going to be economic growth and mobility, right? You're going to have economic growth around the world. You're going to have middle-class formation around the world. People have the means to travel, and if they have the ability to travel, if we don't get crazy with restricting people's movements across borders, again, could go down a rabbit hole. We won't. But I think this setup, with capacity additions well constrained, we don't have as much inflation, or hopefully won't have as much inflation as we had, but you still have a little bit of pricing power. And if you talk about whether it's the bid-ask spreads and acquisition prices, if your setup basis is reasonable, you can make money in this business. And I think people understand that, and they're willing to deploy capital, to invest in this business. And it's not about, next month matters and next quarter matters and the way it plays out, of course, matters. But if you believe in the long-term fundamental setup for the industry, I think you can find ways to deploy capital at reasonable risk-adjusted returns.
And I would argue that the room is full of buyers. The fact of the matter is transactions are not being done because we buy our assets every day. Every day that we choose not to trade or not to transact is a day that we're saying, you know what? I like what is in front of me, and I'm going to hold onto it. So there is that optimism that you both are talking about by fact that assets are not trading, because people look at it and say, why would I buy something else when I love what's in front of me? And that is creating that lack of activity in the market that, as capital allocators, we're struggling with this year and last year.
I also think you have to dare to be brave a little bit. I mean, if you look at the statistics, the last 2 years, leaving aside 2020, which we're just going to rule out as not counting when the pandemic shut everything down, 23 and 24 were the lowest levels of investment volume in the decade.
Yeah.
And 24 was down 10% on 23. So you're in a world where everyone's looking around, trying to figure out who's going to make the first move. And it's uncomfortable to make the first move. You never want to feel like you're going out and putting yourself at risk of being wrong. And I think once you start to see people start to do that, there'll be more followers, and we'll start to see the catalyst for more activity.
That was the $5 billion you were supposed to invest last year. That was the first move.
And I think you could take that to the micro level too, right? You guys are making a bet on New York, right?
That's right.
And you're seeing people think about deploying capital in San Francisco, some of these markets that have been beaten up a little bit. If you're the first person in, you'll do better than others, but then, I think others will follow.
So, Kevin, while we have you, I have to ask, Hilton has made some pretty large acquisitions of brand, maybe not too large, but some
More than zero, which is a lot.
well, I
Seems like
counted
a lot for us, right?
four either partnerships
Yeah.
or acquisitions of brands that you guys have done. Could you talk to us a little bit about that?
Yeah, sure. I'll try to keep it relatively brief. I think on the partnership side, I think you'll see us continue to do things like that. Like SLH was a way for us to bring 400 plus luxury hotels into our system. An area, luxury lifestyle. I mean, you're seeing a lot of those that we're talking about, the ones you mentioned, broadly in luxury and lifestyle, and that's an area where we want to be better. We want more products to deploy to put in front of our customers. If you think about SLH and AutoCamp, one quite large, one small, but two ways to put a different kind of product in front of our customers in a very capital light way, right? So those are just partnerships, no acquisitions. And then the other two, we did Graduate, which again, not the biggest acquisition in the world. And we did Nomad, which was actually quite small. And for us, again, since Blackstone bought the company in 2007, we'd done zero acquisitions, right? It's not our core strategy. But those are both very opportunistic. With Nomad, you think about, we wanted to be in luxury lifestyle. We were going to launch a brand. Like, we were going to be in that space no matter what. We had the opportunity to do a joint venture at a price that we liked and in a way that we think we can bring that brand into our system and grow it. And then Graduate, we love. We love the space. We think it's really unique. You guys know, because you're in real estate private equity, that was a situation where, with COVID happening, and they got a little bit over-levered, and we were part of the solution of restructuring their business, and we were able to buy that brand really accretively and pick up 35 or so hotels in the lifestyle space, but that we think we can take it and make it 400 to 500 hotels.
Wow.
So I don't think it's that globally around the world. So I don't think it's a lot of investors sort of, we got a lot of phone calls from investors like, is this a new strategy or are you getting acquisitive? And I just know that the answer, I'm not going to say we'll never do another acquisition, but we've gotten pretty good at creating, curating, and growing, new brands organically, and that will continue to be our core strategy. When you have an idea for a brand and you do a buy versus build analysis, just to cut to the chase, we almost always, it comes out that build it drives much higher returns on invested capital, and so that's probably what we'll keep doing.
So last year, if you guys were here last year, Scott made some pretty poignant remarks about the current misalignment between hotel owners and hotel brands.
Which is why I'm sitting here.
Which is why Kevin's here.
On this panel.
So
Texted these guys, and I was like, what the heck?
And we want to make sure that you come back next year.
And they said, well, why don't you come defend yourself? I'm like, all right, fine. Let's go.
So Scott, you want to remind us in the audience about your view, and maybe Kevin will leave enough ample space for your response.
I will listen.
I'm not sure exactly what I said last year, but I'll share my views anyway. It was really an elaborate ploy to get KJ to come down and join us so we could upgrade the quality of this panel. So massive success there. It's also good because KJ, for some of you that may not know, worked at Host Hotels for a number of years and managed to get out, I would say, just at the right time in 2007 and transitioned into his role and has clearly had tremendous success. And I'm usually not a very jealous person, but there's one business I'm very upset we still don't own, and that's Hilton, because it's just an unbelievable business model. And one of the funny charts I look at, I don't know why, I look at this quite frequently, and you could look at quite a few actually, you could see a very similar pattern, but I was going to give you one example because it's sort of, there's three pieces to it. So if you look back in the late 90s, which was when Marriott Host spun out in the early 90s, then they sold off their concession business at the airports, and sort of the late 90s, you look at the S&P was like 1,000, so it's up like 6x. Marriott was like $15, and it's like $300 just under today. It was a couple of weeks ago, it's up 20x. Then you look at Host. Host was like $20, and today it's $15, 30 years later. And that just to me sort of symbolizes a little bit what's happened with these businesses as they've separated, they've focused on their brands, they've focused on NUG, they've focused on growth, for their own benefit, for their shareholders. Tremendous job that they've done. But what has it meant for the real estate owner? And for the real estate owner, it hasn't, in my view, been totally aligned. And I'll give you one example where we own a business today called Great Wolf Resorts. And Great Wolf Resorts, since we've owned it, we've roughly doubled the size of the enterprise, largely through development expansions of existing hotels. And in doing that, we haven't grown our corporate overhead or our marketing and sales budget almost $1. Basically 60 million, been the same thing throughout that entire period of time. And so what that means is when I go and develop the next Great Wolf Resorts, the economies of scale that I'm transferring to the owner, the developer of that property, is immeasurably improved. And it just makes more sense to go ahead and do it. And when I look at how much Hilton and the other brands have grown over the last decade, multiples in terms of size of the system, size of the revenue pool, and all of you in the crowd, a lot of you franchisees and owners still pay the 4% program marketing fund, which is clearly much bigger today. And what I would ask is, where is the partnership in that? Why are we not transferring some of that growth and scale and economies of scale and efficiencies to the owners who are feeling the pain when revenues and top lines aren't growing the way we want them to? We've got expense pressures all over the board. And it feels like you're best positioned to try and help us make this a little bit better.
Yeah, and I think we would agree with that. I think we're actually working on a bunch of things internally at the moment to do just that, to try to use the benefits of our scale to drive some cost savings to owners. So stay tuned for that. And I would say, look, we get it. I did grow up on the real estate side of the business. Kristen Seta, who runs our business, grew up on the real estate side of the business, right? So we get it, and I would argue, not argue, but I would say I think it is the ultimate symbiotic relationship. I mean, meaning we understand that there is no us without you guys, right? I mean, at the end of the day, 100% of the capital for our growth comes from third-party real estate investors who are allocating their capital. They're choosing to allocate their capital first to lodging, so we can talk about the benefits of our industry as a whole as needing to be an attractive place for capital to find a home. And then they have to, for us to keep growing the way we're growing, you all have to continue to choose us more often. If we're going to have a premium growth rate, which we do, if we're going to have a premium growth rate, you all have to choose us more than you choose our competitors. And we fully understand that if we don't continue to drive returns, that you're not going to choose to allocate your capital with us. And I talk about that all the time. I talk about with investors all the time. I talk about it internally all the time. There is no us without you.
Yeah, no, and you guys are clearly doing a better job than most, because I think, what's your market share of like new developments and conversions in the US today?
Yeah, I mean, we do half of all conversions in the U.S., right? We have 20% of the rooms under construction globally, and we're only 5% of the installed base. So we're growing more quickly, and that should, that sort of has to mean we're delivering premium returns on capital to owners. But again, if we don't continue to do that, our growth trajectory, sort of will not be the case. And I would argue, yeah, you've had trends where expenses have been growing faster than revenues and margins are getting squeezed. And so, that's been the case for a while. So we have to think about that. But lots of people have made a bunch of money. And I'm not going to get into an argument of like, public versus private and, REITs versus not. And you can talk about they're all our owners, right? So we love them all. But a lot of it is just sort of capital allocation and those decisions that have been made and those decisions that will continue to be made. But a lot of people have made a lot of money investing in hotel real estate over the last few decades. It hasn't all been, one type of company goes this way and one type of company goes that way.
Maybe a comment that, KJ, maybe you can tell me if you agree or disagree. So if you think about U.S. RevPAR growth, and let's just use a flat 2%, which does not keep up with the inflation in the near term. Again, long-term bullish about where this trajectory goes. And that Hilton can deliver, let's just say, double that, right? Just based on being a part of the system, the pipe, and the like. Let's just use this for just simple math. So expense growth is the issue that a lot of the REITs have characterized in terms of their earnings, right? And they're the most transparent, so they're a proxy for the overall business. And we get it, right? It's labor, it's other things. Taking costs out of the system is a combination of brand standards. It's also a combination of technology advancing to a point where you can eliminate things that, still human touch business, but eliminate things. So as a leader, how do you think about that from a Hilton standpoint? Do you believe that, this is the yes and no part, do you believe that kind of success relative to this symbiotic relationship comes from delivering alpha over, what RevPAR growth would be based on market share pricing and the like, and also taking costs out of the system and actually being able to take 4% RevPAR growth and being able to deliver the vast majority of that to the bottom line because you're taking costs out?
Yeah, I think the short answer is yes, it has to be, but then I think you have to balance a bunch of things, right? Meaning we spend an awful lot of money, as you know, on behalf of the whole system, and so you also have to balance short-term performance, right? And that sort of, marketing dollars, that costs money, the loyalty program costs money to run, right? So you have to invest in short-term dollars, you have to invest some of your money in technology, right? So that you can be using the benefits of technology to drive future efficiencies over time, but that costs money, right? It's like this whole concept that and we're doing a lot to invest in AI and trying to think about the future and future efficiencies, but you have to invest money to the bots just don't show up for free and start doing all the work, right? You have to invest money in that. So we think about how do you invest money in R&D. Again, all of the dollars we invest are on all of your behalf. We run it as a co-op. And then you start thinking about standards, right? You have to sit there and say, grind through them and say, the things that we are asking owners to do in the assets, right? Do they move the needle? Does the customer care, right? Or are we just piling on new things over time and not taking any of the old things away because we get some new idea and it's like, bang, new standard. And we did that for, truth be told, we as branding companies did that for a long time. It's like new standard, new standard, new standard. Like when we got to Hilton, when Blackstone bought us, like you pull out the brand standards manual and it was like this big. This is not a new thing. But you got to constantly be thinking about. So when we're thinking about what we're doing with customer promise, it's all about what do customers really care about, right? Great sleep experience, a great shower experience, cleanliness, right? Recognition, right? Know me, care about me. And then some of the other stuff that you just put in the rooms forever because you always have, then some of that stuff has to go away, right? And that has to turn into expense savings. But you can't solve all of those problems at once, right? I mean, like that's the other things, like I say to, some of my hotel owner friends and you guys all the time, like cash flows don't just go up just because, right? I mean, you have to sort of invest, you have to allocate capital the right way, you have to think about what your setup basis is, what price you're gonna pay, and what the growth trajectory is gonna be over time.
I would argue that right during COVID, there was a great alignment for a period of time between the brands and the real estate owners. That was a great mark of success. And as an industry or as real estate investors, this is like this third swing we had to go through, right? We had COVID, then we had this huge influx of interest rates that really put a pressure on cash flows. And now we are and this is not a political statement, with the administration, we don't know what's in the making, right? Government cuts, inbound travel, all of that. It's the third wave in a very compressed period of time that obstacles are presented. And I think that given this volatility, I miss that level of collaboration that we had during COVID, because that allowed us to really work together nicely and weather the storm. I would argue there is a storm coming, just given the volatility. And we don't know what happens to government spending and when does it come back. We don't know with this current policy, 42 countries that are not gonna be allowed to visit. Like, we're gonna have a choppy year in 24. I think it's a good year to get back into the playbook and anchor down collectively so we can survive 25.
Yeah, it's impossible to argue with that, and I would argue, but other than I would just say, interests are very much aligned, right? I mean, our revenues, our fees only grow if your revenue grows.
That's actually the first time
Right?
I've heard survive. It used to be survive until 25, and now we've got to survive 25 as well.
No, we're going to be just fine. I mean, we're going to be just fine. Yeah.
You will.
One question, KJ.
We'll all be just fine.
How well set
I knew
up
I shouldn't have done this,
do
Mel.
you feel like? How well set up do you feel like Hilton is and our industry is as a whole to take advantage of what's going to be a massive wave of AI productivity benefits that's going to happen across the economy? Like, are there just legacy technology system issues that are going to be a big inhibitor to rolling some of these things out? Like, how do we think about adoption of these and how quickly can it happen?
Yeah, hopefully not, meaning, we set out about, I don't remember when it was. I was running IT at the time, which is sort of weird to say out loud. But like we redid our whole tech stack. I mean, the what we call PEP, which is the new property management system, which isn't really a property management system anymore. You used to think about property management systems as these monolithic systems that would run the whole. It's not that anymore. It's a housekeeping API. It's a check-in API. It's a messaging API, right? It's all these tools that you use to run the hotel and communicate with customers. We're almost done deploying that throughout the system, and then we have the last piece, which is the connected room, the TV in the room that serves as the interface between the customer and the hotel. Once we're done with that, our tech stack is completely modernized. Now, will there be another version of a tech stack? I don't know, where it's like it works, there's a different way to do it and it works better with AI. I don't think so, actually. I think our tech stack is plenty flexible to receive what is to come. But again, what is to come is going to be a lot of technology to drive a lot of efficiencies, but there's going to be fits and starts, and there's going to be testing and learning and figuring out what can be done by bots and what still needs to be done by humans.
What sort of functions in the business today are you utilizing AI?
Well, so early on, a lot of like back office, right? A lot of finance, HR, transactional type stuff. Search is very much, or chat bots, right? I mean, I think something like 60% of the outbound communication in the chat bots with customers, whether you're in the booking path or whether you're at the hotels, is now generated by the bot, right? So a lot of efficiencies there. And then I think this is going to be a revolution in search, right? So I think the way customers find the product, right? And so like we got a question on our earnings call about agentive AI, right? And that's like that's like a new thing. And that means the AI, the agent is the AI, right? So the thing, the thing doing the booking in the future, in the near future, might not be a human. It may actually be a bot doing the booking, and that has incredible implications for search, right? So it's all about content, right? So search engine optimization, that's not really a thing anymore, right? It's all about all of the content is discoverable by the world and can be ingested by these large language models. And so how are you putting that content out into the world so that it can be found in the right way and that those bots make the decisions that you want them to make? And by the way, we want the bots to make the same decisions we want the humans to make. We want them to book with us versus our competitors, and we want them to book directly.
Would you view that as making the brands more or less relevant as a result?
More relevant, because who's going to have the, I mean, again, you talk about using the benefits of scale. I mean, who's going to have the wherewithal to make those investments to make sure you're staying ahead of the curve? I mean, I think the bigger companies will continue to have the advantage if we execute correctly.
So sorry, just to move back to one thing. I wanted to drill into something. A couple of you guys talked about how profitability and margin is under pressure, and I think before a few years back, it may have been labor. Then it was, interest rates, your debt costs were up. Feels like real estate taxes or insurance. It just feels like there's a lot of, where are you guys feeling the pain the most as far as where you're seeing the most issues right now in your P&Ls on the expense side?
For me, look, labor is labor. I mean, people need to get paid well. You're going to have that. It's just we're still a people's business. Bots, AI, you're still going to have that interaction. You need labor, and you need to motivate people to work in our industry, especially after COVID. So set that aside. Insurance, we had a couple of tough years. It ebbed and flows, right? For me, the challenge is the execution, right? The business is there. Our managers focused on the business and really attracting it to our hotels. That's the challenge, right? Focus on that. If you get that, labor is managed, right? Insurance will come and go. Taxes are going only in one direction, but you can structure around it. So it's really focused about execution. I think as we are getting, the business is getting more fragmented, right? It started, and we spoke about it in the past, it started the owner of the real estate, on the building, on the manager, on the brand, it was all. And we're just going in the slope of fragmentation, right? And today, the managers are asset light, and there's credit cards that are very lucrative, probably more profitable than managing the hotels. So now we have the brand loyalty, we have the brand, we have the manager, we have the real estate. We're getting away from the hospitality business. So what I would like to see our hotels, it's a craft. Let's focus on the craft. Let's make sure that you run the best hotels. Get the customers, satisfy the customers so they want to come back. And that builds the business. I feel that we have a gap there in terms of talent cultivation, talent growth, and that will be a real shame, because then we've commoditized the business.
Yeah.
Well, and that's the biggest threat, right? So people ask, I don't know if it'd be a different answer for real estate, the real estate side of the business. I suspect it would, but people ask, if people ask us what's the biggest threat to your business, it's commoditization. That is the biggest strategic threat. If there is no difference between, a branded hotel and unbranded hotel, or which brand it is, if it's just about your bot, that knows you really well, understands, the intersection that you're willing to, the price that you're willing to pay to get close enough to where you want to be, then it's game over for really all of us, right?
Yes.
Maybe not for the real estate, but certainly for our business.
I'd love to hear where you're seeing kind of challenges to profitability.
Yeah, I don't think it's anything surprising to anyone in the room, and I think Shai, said this very well, that insurance is going to ebb and flow. We had actually really good success this past insurance cycle. And even in Florida, which is dynamic to say the least, and on the West Coast, as well. I think some of that has to do with loss and the like. I do believe that the labor model, and Shai's right, that we need labor, and continue to find ways to be more and more efficient with the actual labor that exists in our hotels. So whether it's, a mid-scale extended stay hotel, which you've launched a brand that you can, operate, with one full-time employee for every 10 rooms, to, the Conrad in Seoul that Shai, owned, Creative Value, and recently sold. And I think, I think it's really just the model of that business continuing to get more efficient, and allowing to be more profitable. And we've struggled with that as an industry. Shai made a very good point in COVID, and this was like, all hands on deck, and together as an industry, we came together, brands, owners came together, continue to do that. I think that's the most important thing that we can do today.
I think one thing I'd also add about technology is there's a lot of the technology that we're deploying is to make the service experience better. Right, so it's like Shai said, it's like we've gotten away from hospitality. I'm not sure I'd go so far as saying we've gotten away from hospitality, but we're trying to make the hospitality better. And if you want to have fewer people in the building, which we all do, then those people need to be empowered to make, on-the-spot decisions about the hospitality and the service they're going to provide. They need to be empowered to make decisions about problem resolution, right, and recovery, right, which is the most important thing, right? You drive more loyalty from a customer having a problem and that problem being resolved to their satisfaction than you do if there never was a problem in the first place, right? Sort of interesting little tidbit. And so a lot of it is about, can we have better tools for these people who are running the hotels so that they can pick their heads up out of their tablet or their phone or their computer screen, and they can actually look around and see what the customers actually want and give them surprise and delight them, give them a great service experience in the moment, which keeps the customers coming back and keeps them paying more money for the product.
I think expense management right now is helpful, but what's going to drive, I think, confidence in this audience and on the stage to make bold bets is, what's the direction of the macro environment? What's the status of the consumer? Because the headlines the last couple of weeks and some of the statistics that have come out around, the rapidly declining consumer confidence levels and the percentage of people that are uncertain whether they're going to be employed, and their expectations for wage growth is actually at pretty significant low levels right now. We haven't really seen it play out in terms of data or performance of a pretty broad portfolio of assets, but we all know it just is a leading indicator of what's to come. And so the question, I think, for all of us to think about is this a moment in time where certain events that are occurring around us and the volatility of policy is impacting people's confidence to a point where it'll lead to different behaviors? Because right now it doesn't seem like it's leading to different behaviors, but we all know behaviors change very quickly. And I don't know, KJ, if you've seen any signs of that yet emerging across your global business.
Well, I think, look, first of all, I got to be careful because we're a public company and, certainly not going to be updating guidance from the stage. But look, I think you are seeing some of the things that, you can see it in the STR weekly data, right? I mean, and I think if you get behind some of the lack of government spending on travel and things like that, and you're right, I mean, consumer confidence matters. Now, I wouldn't bet against lodging in the long term. I wouldn't bet against the consumer. I wouldn't bet against the U.S. consumer over really any period of time. Could there be some choppiness in the near term? Yeah, of course there could be, because some of the things that are going on do not give businesses and individuals the confidence that, that it's going to be an environment to invest in. But I don't believe that will last I'm not saying we're not going into a recession, because, by the way, newsflash, you're always heading towards a recession. Recessions are actually supposed to happen. You're not supposed to just use the Fed's balance sheet to make sure that there's never a recession. That's not really supposed to be a thing, I don't think. You're smarter than I am. You're nodding. Yeah.
No, I think that's right.
So I think that, but also everybody involved, you have to remember, everybody involved is motivated for the economy to succeed.
Yeah.
Right? The people that are making these policy decisions and sort of trying to feel their way through this are not, trust me, they're not trying to tank the economy, and they certainly are not motivated to do that.
Yeah. What we've learned is every time that there is an impact on consumer confidence or demand, that consumer comes back faster and even exceeds prior peak. Travel is aspirational.
Yeah.
And we know that to be true, even when we think the world is ending and we'll never go back to Vegas again. You'll never sit at a poker table. We'll never do this again. We'll never sit
I
in a
think it's
conference
actually
room.
more
It's
than
like,
aspirational, but I think it's people. I think people view it as a right.
Agree.
Like I think people view, if you're again, the addressable market. Sorry, I didn't mean to cut you off. I mean, the addressable market for travel globally is all of the middle class people in the world, right? That's roughly the people that can afford to travel, and I think that those people. Believe that vacations and experiences is an important and necessary part of life, and I don't think that's going to change.
It's also part of the status, right? The part of the status of middle class and above is the ability to travel.
Yeah.
In the short term, I pay attention to what the airlines report on, and there's clearly impact in the short term. If you follow, name the airline. But at the same time, we're much faster. The reaction is much faster. News travel much faster. Reaction moves much faster among the consumers. And it's become such a part of life that there's plenty of data I'm sure you're tracking of what do you prioritize? A car versus travel, a house, changing a house versus travel. And just part of the quality of life and part of what you work for.
Well, if you look at consumer balance sheets today as well, I mean, they're 70% above what they were pre-pandemic. I mean, people are in a very overall in a strong balance sheet position, have very low debt-to-income ratios. A lot of people have locked in their mortgages. The top 10% of people, from a wealth standpoint, represent 50% of all consumer spending, and consumer spending is 2/3 of the economy. So the people that are really driving the blood of the economy are today still well employed, still growing wages, and they have significant savings on their balance sheet. So it still seems pretty well set up despite some of the headlines around consumer confidence.
All right, so we have just a little bit of time left, and so I'll ask you guys one last question. So assuming we are invited back next year to the Hunter Conference, and we're sitting on stage, I would say, what do you think we will be talking about a year from now that maybe is not getting enough attention now, whether it's an issue, whether it's an opportunity, or whether it's something to watch out for? Would love to just know kind of a hot take on the next 12 months of what you think is kind of lurking around the corner. And I will start.
Oh, I thought you called the end has to start.
No, I'm going to start with you now.
Okay, all right. I think two things. One, I think we'll see a lot of activity happening in San Francisco. I think San Francisco is going to emerge as a market that's going through political change right now, and I think there's going to be investor optimism around it. So I think we'll see that happen. And two, I think we're going to talk a lot more about AI and technology and robotics and what it means for the industry as well as the macro economy.
Great.
I think by this time this year, we'll show up with our favorite soccer club shirts.
Oh, yeah.
Because 2026 is going to be all about soccer. Everybody in the room will have become a soccer expert. Because 26 is going to be a very different dynamic here. You're going to have an inbound of travel. We're going to have 5 cities, including Atlanta, that are hosting the soccer club for the first time in a very long time. And those kind of events have a long tail event, because if you didn't attend the event, you've been watching the games on the TV and you say, well, I got to get to the US. So I think 26 is going to be a very high optimism, high conviction for the country, for the industry, a lot of inbound travel, and I'm very excited about it.
I would say that we're going to be starting where you started your question, which is about capital flows into the industry. And I think what's really interesting is that outside of this room, people don't wake up thinking about, like, I got to go invest in hotels. And you heard statements, Scott was talking about, Blackstone's latest fund and data centers and industrial, and Shai talked about capital allocation. And I believe that, one of the things that we will watch and how much you're going to invest, et cetera, is that where is the capital flowing into this industry? How much of it is choosing to be in hotels because they believe the secular demand trend. They believe that we're taking costs out of the system and we're utilizing AI. And the growth CAGRs feel good, like data centers feel good, like logistics feel good, like even multifamily at 4 caps, and just that comparison. So I would watch that. Pay attention to what the large capital allocators are doing relative to capital flows, and I think that's going to signal kind of this industry and where it goes from here.
Great, thank you.
Yeah, I agree with everything that's been said by my esteemed fellow panelists. I think it will be calmer. I don't think this is going to be it's never going to be perfect in the world, but I think that some of the things that are going on geopolitically will get resolved. I think some of these situations I think, maybe it's hard. It'll be, it's a low bar at the moment, but I think it'll feel a lot less chaotic and calmer, which will lead to all of these good things like capital flow and people feeling good about economic growth and people feeling good about the World Cup. And then you've got an Olympics in the United States in 2028, I think, after that, right? So I think people will just be feeling better because the world will be a little calmer.
Thank you, guys. I would ask all of you to help me thank our great panelists up here for a great discussion. Thank you.